you read that it's a good idea to buy back an option near closing, even if the stock price is just below your option price, just in case something happens after hours causing the stock price to rise and the option to be assigned. Okay, well, that depends on your approach. Let's just go to covered calls for a moment. The weekly covered call we just looked at for our discussion that we just had, marathon, excuse me, was slightly in the money. Okay, and what did we see? It gave us a good downside protection of 8%. We collected a high premium, which gave us that good downside protection. A lot of that premium was intrinsic value because we were looking at an in-the-money covered call. We were buying Marathon around $49.60 and we were selling the 46.5 strike, about $3.10 in the money. So the $4 premium, 90 cents of it was time value, extrinsic. That's giving us the 2.5% return we saw. But there are multiple ways to trade a covered call position. And we're going to go out again to 14 days. We're just going to go straight to the call chain for Mara. And this is not a recommendation or suggestion, but we're just going to take a look at how we would analyze this position. Okay? There are 3 ways to trade a covered call. There are many ways to trade multiple strategies. Your cash secured naked puts. How deep in the money, out of the money, do you want to be? What premium do you want? How far do you want to be? Time frame that you're looking for in those cases. And based on your risk reward tolerance, that's going to guide you to what you want to do. And covered calls is a very similar way, meaning that I'm going to buy shares of stock, 49.46, and I have all these strikes to choose from. Which one's better? Well, it depends on what your goal is for this strategy in your portfolio. Meaning, if I sell that in the money 46 strike, this one doesn't have a 46.50 for the 3-week out series. If I go in the money to the 46 strike, I might get a midpoint around 610, 615. I have a 12.5% downside protection. What does that mean? The stock can fall 12.5% before I'm losing money on the position. If the stock stays above 46, I get assigned and I make 6.3%. That's the maximum return I can make on this position. Unless I buy back in the call, which would be pretty expensive, especially if the Marathon goes up to 53, 54, 55. I'm paying almost the same amount I collected to buy that back to stay in the stock and go higher. This is the in-the-money covered call approach. Oh, yes, and we have a 62% roughly theoretical probability of getting assigned at 46 and making that 6.3% return. This is the in-the-money covered call approach, Ben. This is used for investors who aren't married to the stock, who are looking to generate a return with a high or reasonable probability month by month by month with no plans to roll it. They're just going to get assigned, take their profits, run the covered call search, their search, or one of our default searches for an in-the-money covered call the following Monday, and find new positions with the capital they have freed up now and the profit they made. Or maybe it's Tuesday, depending on how long it takes to clear. At the money covered calls. Time value. And we know that this high premium here, the 618, $3.50 of that is intrinsic value. We're $3.50 below the current stock price. The 50 strike call here essentially is all time value. And this is known as the at the money bell curve. A covered call investor looking to maximize the time value that they get will be selling the at the money covered call. Notice here that as you go deeper in the money or deeper out of the money, the time value declines. The highest is right at the money. This is known as that at the money bell curve, where you always see the highest time value right at the money, any expiration date on any given stock. Right? So to maximize the time value, the true profit on the position, I might be selling an at the money series. Again, I have a potential of a 10.7% return instead of 6.3, and I have a downside protection still pretty good of 8.6 instead of 12.5. Okay, higher potential return because I'm not going in the money, but hey, this is still reasonable for 21 days. Don't get me wrong, 6.3%. That's still a reasonable return for 21-day trade, and I still have an 8.6% downside protection. And yes, so in this case, the in-the-money investor wanted to be called away, Ben, to just meet their target goals with the safety that they want, and they're not married to the stock. An at-the-money covered call trader, depending on what the stock does, in this case, may want to stay in the position. They may want to continue for further growth, or if they really like the time value that they're getting, 10.7%, 8.7% of that time premium, they might think that that's the best premium that's out there for them right now. They might want to continue the trade. An investor who sells the out of the money option, if I want to hold Marathon long term in my portfolio, I sell an out of the money call for a good premium. What do I get? A potential return much higher, 14.5%, much lower downside protection because I'm taking in less premium, and I have a much lower probability of being assigned. This, if you wanted to hold the stock long term, and you're trying to generate just monthly income against a core holding in your account by selling out of the money, maybe even selling at the money, then yes, it's not a bad idea what you mentioned. In other words, if I had started this position, I bought the stock at 43, or my cost basis Ben on the stock is 43, and I had sold the 50 strike call for November 12th, for example, and today the stock moved down. So yesterday, when the stock had moved up above 50, it's down $1.45 today. Yesterday, when the stock was above 50, I might have considered buying it back for the weekend just in case it suddenly gapped up to 53, 54. Or instead of just buying it back, you said buying it back, closing if the stock price is just below your option price, just in case something happens after hours causing the stock price to rise and risking the option being assigned. What I probably would have done in this case is if I was holding the 50 call and my original cost basis was 43, and yesterday the stock went up to 50.90 roughly. It was probably 50.92, 50.93. It might have been right at 52. Instead of just closing the 50 call, I probably would have bought this November 50 call back. Again, goal is to stay in the position and not to be assigned in that case. And I would have rolled up to maybe the 55, 54, and probably had to go out to December if I wanted to roll for a credit, maybe further, depending on what I initially collected. Rather than just closing it, I might have rolled it up already to the higher strike prices, especially if my plan is to stay in the stock long term and continue to get income. Why just buy it back and just leave it sitting there? If I'm going to sell a new call anyway, why not just roll it out? Evaluate rolling it up if it was slightly in the money or just below it. Normally in those situations, even Ben, if I'm in one of those married put positions where I sold a call that's just income method number one, there's a right and wrong time to do it. But let's take, let's just take a custom spread real quick for this example. I'm going to use ESI, the new married put that I opened, but we're going to put in a lower price. I'm going to say I bought it at 20. And I still would have bought the May series. Maybe a month ago, it was below 20. But I got to buy the May 22.5 put, and let's say that I paid about $3 for it. Oh, no, that's too low. I'm sorry, $4. Okay? And that's about right. So there's my married put with a 6.3% risk. Now, as the stock has moved up, as it has, it dropped down to 22. It was at 22 a little while ago, but let's say that I did sell the 22.5 call for about 70 cents. Maybe when the stock had moved up to 21.80 or 21.75. Okay. Now my call is slightly in the money. I did lower my risk down to 3.4%. The max profit, if the stock's right at 22.50, in this sort of calendar collar, is 5.1% of what I invested into the position. But I have an upper and lower break even. Probably wouldn't have done this, but that's okay. What Ernie and I tend to do, let's say I opened this 15 days ago, Ben, and the stock did what I wanted, so I sold the call, income method number one in the blueprint, to lower the risk, generate premium. I didn't expect it to go too far above 22.50. But what Ernie and I tend to do is that even in this situation, because I am planning on holding the stock for higher returns, I'm more bullish on it, we don't typically close it when the stock starts to reach this price, okay, when the stock gets here. We usually let it go a little bit in the money, maybe by a point or two, before looking to roll the call. And why is that? And it goes back to that at the money bell curve. I had sold the 2250 call when the stock was, say, trading at 21.80 or 21.90, maybe $22. So I was over here on the at the money bell curve, kind of at the money, but I'm trying to maximize the time value. Now that the stock has moved up and is pretty much right at 2250, a little bit above. That's bad drawing there. Let's do that again, okay? There we go. So at the money bell curve, we sold the 2250 when the stock was, say, at 21.90 or so over here. That would have been the at the money. The peak would have been at a 22 call if it was available. We're on this side. Now the stock has moved up beyond it, but we're still close enough that now this 2250 call that I'm in has the highest time value for any expiration of any of the other options around it. Meaning what? I sold here at the lower end, one of the lower ends of the at the money bell curve, and now I'm buying back at the height. No, I'm going to maybe let this go up to 23, oh, it is at 23, but 23.50, maybe 24. So it goes more this way. I'm sorry, it goes more this way. So now the 25 is kind of over here on the at the money bell curve, and my 22.50 is kind of over here. Yes, I'm paying more intrinsic, but I'm buying back into a lower range of the at the money bell curve. I'll be selling that 25 right around the same value that I did there, not buying back at the height of the ATM bell curve. The discussion you mentioned, Ben, is valid. If the stock I'd sold the 25 call as a covered call or inside a married put that I wanted to hold long term, and the stock had moved up to 22.40 or so on a Friday, is it tempting to buy back this call now so I don't have to worry about the weekend of it suddenly gapping up to 24 or 25? Potentially. But if I'm buying it back for more because I sold it when it was out of the money and in just a few days it went to at the money and this buyback cost is higher, I might be okay leaving it alone, because if it does go up in price, I'm buying back into intrinsic gain mostly, which I have in the stock if I plan to stay in it, and I'm looking to sell the new call that's at the higher point of that ATM bell curve, a 24 if it's available, or the 25. That's why Ernie and I let the positions go a little bit in the money first, so that we're trying to go to the next strike that hopefully is more closer to the peak of the now at the money bell curve, because we're trying to maximize the time value on the calls that we're selling, much like that at the money covered call seller. That's our approach. Doesn't always mean it's the right approach. I got burned on Berry Plastics, of course. Similar situation to this. I didn't expect the stock to gap from 65. It was actually at 64. I sold a 65 call, and in 3 days it gapped up to 71. I wanted to stay in the position longer, and I did make a mistake, I'll be honest. I bought back the call for a hefty price, rolled it to a 70 call, and a few short weeks later the stock Berry Plastics had pulled back down to $60. So I had increased my risk on the married put because of the short call. Had I not done the short call, I would have had a 9% profit when the stock was at 70 just in the married put position. I could have done an income method number 4, bulletproof the trade, but I had to pay the high price back for the call, then manage the put to get back to a normal risk, 6-7%. Thankfully, Berry's been climbing again, so I have an opportunity to do some adjustments before the earnings and lower that risk from 7% down further. Okay, but yes, it's a valid approach, but again, sometimes over the weekends, the stock does jump 5 or 6% on good news. Sometimes it drops down 5 or 6%, in which case I'd like to keep the hedge. The only hedge you have in this case is the call premium to lower that rather than risk it dropping 5 or 10%. There's trade-offs to each approach. Ernie and I prefer to let it go slightly in the money first, trying to take advantage of the at-the-money bell curve, buying back into a lower end of the at-the-money bell curve, even though we're paying a higher intrinsic value, and sell now a higher strike or a new strike that's closer to the peak of the at-the-money bell curve. We'll let it go in the money a little bit and evaluate the new premiums that are there. That's our approach, Ben, for covered calls and for covered calls inside the married put position. So I wanted to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing in performance and options knowledge. We talked about some of the questions that some of the questions that had come in today, of course, were related to married put, adding more shares to the married put. We talked about the covered call positions, using a naked put to potentially get in the covered call, similar to the wheel strategy. Is a covered call or a naked put a conservative strategy? And we talked about the married puts and long collars as being more conservative strategies. This, again, does not mean that I am opening positions on ESI as a cash secured naked put or as a covered call that we saw, or Ally Financial, but we do have married puts open on those positions in the Fusion portfolio at Radioactive Trading. I opened ESI as a married put, might have opened it as a standard collar, which I think is more conservative, but again, it is open as a married put in the Fusion portfolio at Radioactive Trading. I'm not opening a new position yet. I just want to remind everyone that any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. Options do involve risk and may not be suitable for all investors. Now, we had a chance today to look briefly at the search tool with the naked puts that came up, the covered calls that came up for Ben's discussion. We also looked at doing a naked put on ESI, of course, through the option chain and the different ways to trade covered calls through the option chain. We saw how the portfolio, had I opened a married put position, we saw that we had opened a married put on Ally, of course. If it was right at the peak, right before that 10% decline, we'd only been down 2.7%. Whereas with the covered call, we'd be down more like 7 or 8%, depending on the 2 or 3% premium that we got on that position. We saw the stock repair tool in action as well. But if you like some of the tools that you saw today, of course, just remember you can take a 14-day free trial at any time. Just go to powerop.com, put in your name and email address, and of course, no credit card required. You'll have full use of the site for 14 days. After that, of course, subscriptions start at only $45 per month. That's with the end-of-day service, end-of-day data only. We do have a delayed service, which is probably our most popular service. Most subscribers are in the delayed service. That's only $65 per month. You can also upgrade to the historical level of service. That includes everything that you have on the delayed service with full access to the historical data for the historical searches and the different strategies in the historical option chain. That's only $100. And of course, we do offer a real-time service as well. And the premium service includes everything, full historical real-time data and access to the API, the programmer's interface, if you wanted to write a certain program to interact with that as well. Of course, we discussed a little bit on the webinars page just a moment ago and on YouTube. You can go to our archived webinars page at any time. Just go to poweropt.com/webinars.asp or just go to poweropt.com and you'll see the free webinars button. Or if you're logged in, you click the free webinars link there. Or just go to the YouTube channel as we saw a moment ago. You find Power Options on YouTube and you can use that search function that we just looked at to look for long calls or diagonal spreads, poor man's covered calls, naked puts, covered calls, and more, and you'll see a variety of different videos that are available with our thoughts on those topics as well. And of course, if you have other questions at any time, you think of a question later on this weekend, send us an email at any time to support@poweropt.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Of course, trial members and subscribers schedule a free coaching session, as we discussed for Michael when he asked about that one-on-one teaching that's available. Again, for trial members and subscribers, we do offer the free coaching sessions. You can schedule those when they are available. That's essentially a 35 to 45-minute phone conversation with myself or Ernie.